Okay, let's get started. I think we have everybody on the meeting, and we're ready to go. Hi, everyone. I'm Phil Krivacek. As Paul mentioned, I'm a managing partner here at Indeflex, and I want to thank you all for joining us for today's webinar, The New Normal: How COVID-19 is Impacting Payments. We're very excited to host today's webinar on this timely subject, and we look to deliver critical information and perspective that'll help educate you, the industry associate, as well as, and just as importantly as, the business that you serve and engage every day. And we're honored to have Mike Gramz with us today as well. I've known Mike for many years, and he's one of the most respected risk professionals in our industry. Mike serves as Chief Risk Officer for Yapstone, and has also held senior roles at Merchant eSolution, Bank of America, and Bank of America Merchant Services. Actually in those roles, Mike also did some work with government regulators to provide perspective and advice in crafting regulation and legislation. He currently sits on Visa's Executive Risk Advisory Council, and we're very proud to have him also sit on Indeflex's advisory board. Mike, thanks for joining us today, and thank you for sharing your expertise and your perspectives on what some would say are uncharted waters for the payment industry.
Well, thanks, Phil. I really appreciate it, and connecting with everybody here from the bunker in North Carolina, and hopefully we have some great opportunity to have some good dialogue today. So the agenda, as I have up on the screen here, is let's talk about consumer spending, refunds and chargebacks, how they're impacting you as a sales organization and our merchants. What is a high-risk merchant, and how has the pandemic impacted high-risk merchants and their how they'll access payments in the future? And then really, what's the most important, what's going to be the new normal going forward? So when we talk about consumer spending, and you go back to what we define as the pandemic really impacting payments, for us, it was March 9th. That's when we really saw a significant uptick in chargebacks, refunds, cancellations, and consumer spending behaviors. And so the early impacts that you'll see here that we've documented are, consumers hoarding cleaning supplies and paper products. However, grocery stores and online merchants, they were actually able to maintain and even in certain cases increase process volume during that time period. Restaurants continued processing and were protected from catastrophic downturns. They were really innovating with takeout, but more importantly, online curbside pickup, and developing sort of that online presence so that you could, instead of having to call in and have a queue of 100 orders on the phone, being able to take orders online. But more importantly, as it related to Yapstone and our experiences, vacation travelers began to shelter in place as various municipalities demanded or mandated prohibiting out-of-town guests from traveling. And then the immediate impacts to that was a catastrophic avalanche of cancellations that really devastated spring break. So in the current environment, what we're seeing, and I'm sure all of you on the phone are seeing, is consumers are adopting and expecting a contactless form factor. Contactless is no longer about convenience, but really consumers are starting to rethink this and more about health and safety. When you look at the right-hand side, the key impacted segments, travel obviously was the biggest impact, as individuals couldn't fly, couldn't reach their destination, but not only could they not reach the destination, but the homes, the short-term vacation rental homes or hotels or the lodging which they were expecting to arrive to were actually closed, and some of them even mandated by the local municipalities that they could not operate, and out-of-town travelers could not arrive. What we're also seeing is grocery, it still has impacts. However, the impacts are more on the headwinds now, as you're seeing product shortages and supply chain limitations and limiting the hours of operation. And then food delivery and online marketplaces, they've really remained very resilient as they've been able to maximize the sort of no-touch engagement with the consumers. Consumer spending, what's next? I think we all are following the analysts and the data, and we realize some restaurants will never reopen. and consumers remain cautious about prepaying for services. And we'll talk a little more about that when we talk about NDX and advanced payments and high-risk merchants. And then I think when you think about where the consumer spending, when it will recover, it's really going to be dependent on the length of the unemployment curve. But really, I think one question we all have to have in the back of our minds is, how are we going to build trust back into the ecosystem for a consumer to pay in advance, say for a vacation or a furniture order or some type of good or service that's going to be delivered in the future? So let's talk about the real financial impacts, both to merchants, processors, and acquirers today. And while it looks pretty confusing what I have up on the screen here, what this is a model that my analytics and data science team has put together. And this model is really showing how the velocity of refunds and cancellations have crippled the industry in March and April. However, there is a silver lining and some good news here. And I'll explain what we're looking at. So this would be January and February. These are refunds that happened in month. And so when you look down here, this would be January 1st. Go all the way out here to about day 59 is March 1st. And then you go out here is April 1st. And so you would say, wow, that's a pretty steep curve for refund velocity in January. However, just remember, that's coming out of the seasonality of holiday and vacation travel during December. And this would be the trailing refunds and chargebacks associated with that. So that is not alarming in any means. And by the way, you can see it had a fairly low curve and a distribution that went across multiple months. February is really the control group that you see here. This would be a normal distribution of chargebacks and refunds across a lengthy timeline. Then you get into March. What happened here in March? Here's about March 9th when we really saw the impact for chargebacks and refunds on the travel industry. The very concerning thing about this is this would have been vacations booked and arrivals for in the March and April timeframe. What this is telling you is that around this period, refunds and chargebacks accelerated at an unforeseen and never experienced before velocity. So you had a very, very high rate of cancellations and chargebacks in a very short period of time, approximately 30 days. And not only was it impacting the travel in March, but the consumers were spooked and they started to cancel April, they started to cancel May, and then you started to see a slight uptick coming out of March and into April of June and July travel, vacation travel. Now, while this is very alarming and it was significantly impactful to the merchants, and this same, we've been able to extrapolate this data across other MCC codes, furniture and others, and you would have seen the same sort of experience as merchants began to not be able to deliver products because of supply chain issues or the manufacturing facilities were not available. But the good news that we see here is that in these timeframes, while it concentrated refunds and chargebacks into this 30-day period, what the data will show is that if there is another shelter-in order or the shelter-in is extended out into the June timeframe, the velocity of the refunds what the merchants will have to fund out of their accounts will be much less, because as you can see here, for June, about 40% of the trips had already been canceled and refunded. So you're not going to see this, which will make it easier from a financial perspective on the merchants to be able to issue those refunds or work with the traveler to rebook. So what does this mean for everybody? I think that one, there's good news around the financial impact to the merchants. But number two, the bad news is that you have an ecosystem where there's millions of refunds. Think about the cruise lines, the airlines, the hotels, the vacation rentals, where those refunds are actually stuck into the system. And what do I mean by that? We're getting an enormous amount of calls from our customers, and then the feedback that I receive from my peers in the industry is consumers are wondering where their refund is. Where the merchant would have said, I actually submitted the refund, say in mid-March. we're at May 1st, and some of those refunds have not even hit the cardholder's account yet. So why? So I think the important thing for the sales agents and the merchants on the phone here is we have to educate our customers that the delay in the refunds is not because of the merchant or the merchant's financial viability. What you're seeing is processors and acquirers are holding those refunds for a set period of time, many up to 30 days, to ensure that there's not any ACH rejects or bounce backs coming back to fund those refunds. Because what we're seeing also in the vacation industry is some of the property owners did not have the cash available on hand to refund as you go down here multi-month stays all in the same 30-day period. So that's causing risk for the processor and acquirers. And we're going to talk a little bit about how that impacts us and how it's impacting the new normal in the future part of this presentation. So how are sort of the decision or policymakers reacting to the pandemic? It appears that Visa is leading the way. In April, Visa launched a COVID-19 monitoring program. And what they're doing is they're really monitoring what the issuers are submitting as chargebacks, and then the merchants, their velocity and their appetite to issue a refund or a rebooking. And so why is that important? If you go back to 2007, 2008, coming out of the last financial crisis, issuers and banks were really pressed for profitability. So they innovated around automated systems to process large numbers of chargebacks with lower OpEx or administrative overhead, meaning less people. That innovation, while it worked really well over the last couple of years in the good times, is causing significant stress for merchants particularly, and I'll explain. So think about this. The issuer will have, say American Express, for example, could have millions of chargeback requests from consumers over the last 30 days. They never, in anyone would expect that they would have enough staff to be able to review those. And so you actually give them credit for having scalability in the platform to be able to process those. The problem is many of the consumers are getting frustrated with the length and the time of delay for the refund to hit their accounts. So what they're doing is they're issuing a chargeback. So where if you would call and talk to an issuing chargeback agent, they would generally ask you questions like, has the merchant offered a refund? Have they offered to rebook? And if you answer yes to those questions, you're not eligible for a chargeback, and they would have stopped the dispute process there. But lacking the ability to review each one of those chargebacks, hundreds of thousands, if not millions of those are being sent to merchants without any review. So you say, well, okay, the merchant gets it. All they have to do is respond and say, oh, I offered a refund. What they'd likely win that chargeback. But the problem is the merchants are being inundated with such large numbers of these that A, they can't respond to the chargebacks timely, but more importantly, when they issued that refund, payment facilitators like myself and processors, we actually recaptured those funds out of their checking account. Now the chargeback comes in, we're recapturing those funds again, and the merchants are being significantly stressed from a cash flow perspective as they're being double debited for those disputes. So Visa is really working hard with the merchants and the issuers to try to put some controls in place to ensure that the chargebacks that are coming to the merchants are those that are legitimate and require a response. What has Visa done, though, to actually aid in some of this? The unfortunate decision that the networks have made is that they're not extending the timeframes for which merchants have to respond to these chargebacks. That really would have given merchants the ability to go. So for example, in Florida, there were certain municipalities that actually mandated that no traveler could come into their county who didn't reside in that county in a permanent residence. So in that case, as difficult as it sounds, the traveler is not allowed to charge that back because it was a governmental mandate. And I guess the assumption would be that both the traveler and the merchant will have to share on some of the risk. So going and finding all of those governmental orders or municipal mandates and attaching those into dispute response, that takes a lot of time, particularly when you will have 20, 30, 100, or larger property management companies, 1,000 of these. So what Visa has done is they've actually modified the operating regulations to say that a merchant actually can amend a response to a chargeback dispute. So why would they do that? So what it allows the merchant to do is to respond with a very light touch to say, yes, I am going to dispute this. But now up and through the pre-arbitration process, the merchant can then amend, gather these important legal documents to be able to put together in the response and resubmit them that will increase their chance of winning the dispute. So while the bad news is that the timeframes haven't been extended, and I think that decision will be revisited on a monthly basis, depending on the velocity of chargebacks. Currently, right now, what we're seeing is 5 times in chargebacks in some of our businesses, but in the core business that is really vacation rentals, we're seeing about 10 times the amount of chargebacks coming through, and it's very, very impactful to our property managers and the merchants themselves. So why are the processors, acquirers, why are you submitting applications as a sales organization? And why are merchants having trouble, some merchants, even procuring new payment processors in this time? And Phil and I talked about this, and we thought it was maybe important to go back to a little bit of 101 on merchant processing and risk management, and really talk about advanced payments and more specifically NDX. And so NDX is a term that risk professionals reference and we throw around very casually, but really what that is non-delivery risk exposure. And you ask, what does that mean? So think about a furniture store. You come in and you buy a $10,000 couch, but that's not going to be delivered for maybe 90 days or 100 days, but they're going to require you to pay 50% of that up front. So what are the chances a risk professional has to ask of 90 or 100 days from now, if that merchant or that that storefront is not going to be in business and that consumer is not going to be delivered that product, what is the risk associated with that and their ability to pay? And so you look at, in the middle of the screen here, what are examples of high risk NDX exposure industries? Airlines, that's obvious, vacation rentals, storage rentals, cruise lines, bed and breakfast. But then, sometimes we forget about subscriptions. Think about education and warranty companies where you pay in advance for a whole semester, or you pay for a year of insurance, or you pay for a year for a warranty. Those are considered high risk because you're paying in advance. And why do processors and acquirers care? Because a merchant would think, well, that's really my problem if I can't deliver it. Because if the merchant goes out of business, because of the way the contracts work and the hierarchies of the payments ecosystem, if the merchant can't pay, then Yapstone will have to pay, or other payment facilitators in the industry or acquirers. They will actually have to step in and refund those funds if a chargeback is lost. So they take an enormous amount of time looking at these types of industries, building models to risk rank, building models to look at and measure forward delivery risk, and then assigning risk scores to them. And then that's how we determine whether you need a cash reserve, whether you need a letter of credit, or if it's going to be, you can go as is. We won't require any of those collateralized options, but what we'll do is monitor you either monthly, quarterly, annually, semi-annually, just depending on your risk. So when you're out there selling and your merchants are asking, why do I have to submit certain documentations? It really all feeds into these models that we build to protect us from the future delivery. If you can imagine, a year ago, with the economy as strong as it was and consumer spending, there was a constant flow of cash coming in and going out, and the merchants never really experienced much failure. What we've seen, though, in the last 30 to 60 days has been catastrophic across many industries. You're looking at companies like Norwegian Cruise Lines having to get $3 billion lines of credit. Airbnb went out and had to secure an additional $3 billion in financing. Many other vacation industry leaders are having to get the cash to be able to not only fund refunds to prevent chargebacks, they're refunding to build consumer trust so that they know that they can come back and their money's going to be there if they have to cancel. So I think the next thing to do is let's pivot to what's the new normal really going to be for those of us in this industry. The new normal is some processors have temporarily paused boarding any new high-risk MCCs. Essentially, they're taking a breath, licking their wounds, trying to evaluate and analyze and measure what their current risk is before they start opening the floodgates to these new businesses. Client selection is really going to be key to sales growth. And educating your merchants on the changing underwriting standards, particularly, I think that you're going to see a significant uptick in demands to see financials, whether they're audited or unaudited, pro forma financial statements around growth. And then you're going to have to, obviously, what we always ask for are the bank statements to be able to prove that you have the cash to be able to support the underlying business and any future delivery risk you have there. But more importantly, I think focused on the vacation industry, is there going to be a wave of new regulations focused on protecting consumer funds. So for example, if you're a licensed property manager and you're registered in a particular state, many of those states require you to restrict the cash or put it in an escrow or trust account pending arrival of the consumer. And why would they do that? To protect against exactly what is stressing the industry today, that when a consumer cancels and they're due a refund, that those funds are there to be able to ensure that they can either rebook or cancel altogether. And there's going to be changing accounting policies, I think. So around the restriction of cash, around the recognition of revenue, as it relates to the future delivery of products, that's going to put some of these industry leaders on the defense and trying to fund and raise capital to be able to operate in these periods when you have a long time between delivery or taking of payment and delivery of the product. So I guess the obvious question is, when will we recover? For some, unfortunately, never. However, there is some encouraging news that we have pockets of municipalities that are experimenting with easing shelter-in-place mandates. The outcome of those will really define how and quickly the rest of the country can open up. If you're in a region or a city like New York, it's likely going to be a very long time before you get out of phase one of any easing of the restrictions. However, there's still many places around the country that have adequate hospital space, adequate medical facilities and equipment that you could open up and continue to progress to phase 2, phase 3, phase 4. And I think what you're going to see now is a much more regional and even very specific in a municipality easing of this, which is going to aid the merchants that are in those locations. And finally, the answer is, when will we recover? It's really unknown until we start to see the data and the analytics coming out of these easing of these local jurisdictions. But I do think that by June, first week of June, second week of June, the May data is really going to tell us when the economists are going to be able to predict a recovery. So Phil, Paul, that was pretty much the main points that I wanted to go through today. And I think the most important part of this will be the dialogue with the participants and maybe jumping into any questions anybody may have.
Yeah. Hey, Mike, thank you so much. We do have some questions that have come in, and let's take a few minutes to answer some good questions. First, great question. Are there any products or verticals that I should be looking at in this current environment?
Yeah, let's go back to what the consumers are asking for. So when you walk into a merchant location, you see this hesitation to be able to hand over your card to an individual or even dip your card into an existing terminal. And many merchants are still even requiring the signature on the SIG capture on the terminals. I really think that for those on the phone, really start thinking about pivoting the equipment and the devices you're selling to contactless. For 10 years, we've been trying to sell contactless out there as a method of convenience and speed. I really think in this time period, the consumers are not concerned about convenience and speed. They're concerned about health and safety. So any selling strategies, or for merchants, if you install the contactless devices, you're really going to be giving more trust and confidence from your buyers, which will probably result in increased payment volume.
Yeah, thanks, Mike. And I saw a stat here just recently around contactless. Although, Europe is, in pockets above 60 and some pockets above 70% adoption. In the US, we are, I think, still below 5%. So a lot of runway there.
I would agree.
Okay, next, for retail restaurant, does online ordering or mobile ordering apps increase a merchant's risk profile?
Yeah, that's a good question, because for years we've heard that the fraud is much greater in card not present. However, I think that's a little bit of a legacy view, because understand that when I'm taking a payment from a card present merchant, I have one device, one location, a MID with multiple cards coming through on that MID. The only risk that I can really measure in that instance is associated with that MID, and talk about velocity, and then you may get a lost and stolen in there that's declined by the issuer. But the technology is advanced so much in the card not present space. So for example, when I'm getting a payment or an authorization request from a card through a card not present merchant, I'm actually able to identify the IP address of that device, the device fingerprint, the geolocation. Then I can marry that up with the merchant's risk profile. So what we call that the persona, where you go from monitoring risk from just the merchant or just the card to now we're building a model that it's taking the information from that consumer. So now when you go to the consumer is never giving their name, their address, their billing address when they walk into a merchant. Online, that's all required. And believe me, much of it's required for shipping, but even for shipping of products, but even in those industries where you're not shipping, if you're just ordering online, if somebody's asking you for your address, it's really around risk management. So what I'm doing is I'm taking the information that I have from that individual, their name, their address, their device, their phone number, and we have terabytes of data that we quickly run again the model against to say, have I ever seen this information? Check, nope, check, or yes, good, and I'm actually their repeat customer. Skip a couple steps. Then you actually marry that with the merchant risk profile and with the card profile. In the end, what we're seeing is we're able to manage risk at a significantly lower, and fraud at a lower amount than we were even in the card present space years ago. So in short, to answer your question is, going to an online model is not going to increase your risk profile.
That's great news. Okay. Lots more questions. Let's see. Next, should I stay away? This is kind of similar, but a little different. Should I stay away from any business that does delayed delivery, even when it's a very small part of their business? For example, retailers who have some special order.
No, let's dispel that myth right away. I wouldn't redline any particular industry. I would continue to go after even those merchants with high delivery, non-delivery risk, but just educate those merchants that the underwriting standards are going to change. You're going to have to provide more information. You're going to have to develop a relationship with your acquirer or processor, and you're going to have to share. And while that's inconvenient, it's going to allow those that do it well and those that educate their merchants that there is opportunity for growth. Because believe me, the processors and the acquirers, when you go back to that screen that talked about payment volumes being down 80% in some segments, 50% in many others, we need volume. We need good volume. But what we're going to do is we're going to board it with a little more diligence. However, it's not going to result in particular industries just being completely eliminated from the payment system.
Great. Okay. Great. Thanks. Is there a way for a merchant to protect themselves against chargebacks?
So if I was to answer that question 60 days ago, you could go back to, the network's chargeback best practices. I think in the new normal, it's going to be all about educating your consumer or your buyer on the refund process and the refund timelines. So the chargebacks that are really crippling the industry today are the non-fraud chargebacks deemed credit not processed or refund not received. And again, I'll reiterate what we spoke about earlier. This isn't this isn't because we have merchants that are bad actors, which you would immediately, as a consumer, sort of pivot to. This is about that the payment system is flooded with disputes. It can't handle, from an operational perspective, the velocity of which these disputes are coming through. So it's all going to be about education, and it's going to be about patience, not only from the merchant being able to respond to this flood of chargebacks, but the consumer in being patient that the refund may not be coming in 3 days or 7 days, but could be taking 3 to 4 weeks now.
Okay, thanks. Next question. If you were going to give one piece of advice to a merchant about risk, chargebacks, and refunds, what would it be?
So I think managing risk from a merchant perspective it's easy. So maybe I would pivot from being a risk professional to a business development or a growth person. I think you need to start looking at your methods of acceptance and the channels of which you're servicing your customers, and really focus on growth. And what I mean by that is, again, go back to contactless, deliver a product or a service that the consumers are demanding, and develop channels like an online presence. If you're in a restaurant, while it didn't make sense for you to do anything more than maybe publish a menu out there, put a payment acceptance page on there so that you can take payments for convenience for the consumers, because they don't really want to give you all of this information standing on the sidewalk waiting for their curbside delivery. They'd rather fill that out while they're at home before they get in their car or before they leave their home to walk to the restaurant, where all of that information is populated. So the only action that you have to take as a merchant is actually fulfilling that order and not having to worry about anything else around risk.
Thanks, Mike. Are there certain industries to avoid? At one time they were good, but now we should avoid them?
So I think that vacation is one, not vacation in general, but I think we have to accept that boarding, hotels, motels, lodging, bed and breakfasts, resorts, that's going to be pretty difficult for somebody to get into that new in this time period. But I'm very confident that as we come out of the summer months and the processors and the acquirers get comfortable with the risk and the recovery that's in place, they're going to open that back up. So don't give up on the vacation industry. Actually make plans and sales strategies and start sort of giving the calls out there, the warm leads, meeting with the individuals. And by the way, if it is a good customer, they're financially sound, there's always an exception to everything. So continue to keep your focus. But if I have to really think about one that is going to be a caution point over the next 60 days, and that's even impacting the existing merchants who are trying to move to different processors, they're really going to be stuck with where they are in the near term. But again, I think coming out of the third quarter, I think we'll get back to normal.
Right. That actually answers another question we had, which was, when do you think we'll be able to onboard lodging business again? And it sounds like, we're a few months out, but in the current environment, that's really not too bad.
Yeah, and I don't even mean to again use the word sort of redline that industry. There are those of us that have great risk management processes that we're able to that we're still allowed to board new business with the acquirers. And I think it's as a sales organization, you know, find those partners that have the ability to do that, and then just continue to sell.
Might be the last one here. Is there any conversation about removing the signature requirement altogether?
Yeah, that one, I don't have an answer for that one, but why don't we take that back, do some research with the networks, and we'll distribute that out to the audience.
Okay. And last one, kind of similar, but how do you see NFC/contactless payments impacting the overall future of payments?
Yeah, I really think, you know, who would have thought the struggles that the networks have had over the last, you know, 5 years of trying to get merchants to upgrade their payment acceptance devices to contactless, and then all the disputes over accept all payment types as Apple Pay and Samsung Pay and everybody came into the industry. Those disputes, I think, will probably look silly now that the consumer is driving the choice and demanding contactless. So I just can't reinforce, you know, for a sales organization or for a merchant, the importance of listening to the consumer and what they want. And I think that's probably at the top of the list right now.
Yeah, you know, I keep having questions come in, but thank you, Mike. I just let's get to see if we can get a couple more in. I know you see a lot of data and some broader beyond risk, but this question is best top revenue small business to target today in the midst of the pandemic.
Yeah, you know what? You know, I'm just the risk guy, and I'll maybe turn that back to you and Paul to think through and to respond to. But clearly, what we're seeing is, I mean, just think about your own experience with your families, online medical and healthcare, meaning the virtual office visits, the online ordering for restaurants is just. I don't think, in my personal opinion, that you're going to see a dramatic shift back to away from that channel. I think that it's the new normal for the restaurants to be able to service that customer need. But you know, what do you and Paul think?
Well, you know, I think what we've seen is if I look at some of the broader numbers that are just coming out from the month, I mean, you would look at, you know, obviously auto, home improvement, and certainly you mentioned healthcare, you know, they're and B2B, but I'll go back to healthcare. You know, there are a lot of folks who have never worked with a medical office or and those are better targets than most people think. And healthcare, although we saw a slight dip in healthcare overall processing volumes, I think because people were afraid to leave their house, I think that is, you know, certainly the way the service is delivered, and the growth in that industry probably as a result of all of this is a great target. Paul?
Yeah, I mean, I would say, yeah, I mean, you know, I think that, you know, even restaurant, I mean, while we're going to see, you know, a number of merchants that their volumes may, you know, continue to be low. What we've seen over the past 2 months is that
Paul's breaking up a bit. Hey, Paul, you're breaking up a little.
Maybe you and I can take any other questions that are out there.
Yeah, I'll do that, and I'll say I think I know where Paul's going with that one. We've had a conversation, so I'll take a shot at it. And I think what you know, you have a lot of restaurants out there doing a few things, many things. You're looking at different models, right? Online ordering models, curbside pickup, delivery models. There are some innovative. Even our own agents have really built some innovative tools that help restaurants. Although a lot of, you're right, some may not open, but the ones who stick around, I think, are going to be looking for advice on how to grow their business and adapt their business. And when you think about it, there may be folks out there right now who really enjoy having their food delivered or picking it up at the curb. And you know, the better we can facilitate some of that. And I do think, there's going to be, the turmoil within the business when those businesses do change hands, and that may happen out there. I think, folks have to be ready to have this conversation with the new business owner. And I believe that folks who maybe didn't look at payments, restaurants owners who are there and maybe didn't look at payments as being critical or something they should have more view into, will probably be more accepting of a conversation. I think some of these businesses would be a great target. Let's see if we have anything else, man. I don't think we're gonna be able to get to all these. One more, Mike, I'll give it a shot. Are there any forms that a merchant can have in some of these troubled verticals, any forms or documentation that a merchant can have a customer preemptively fill out that would protect them from these risks? And in that vein, I know the travel has come up a lot here, but maybe you can expand that answer into why. I mean, travel has almost single-handedly, almost completely single-handedly caused the industry, the acquirers or processors to, create a new process for the balance of the merchant. That be a fair statement?
Yeah, I think it is. I think, the old statement that there's always one person that ruins it for everybody. I say that sort of jokingly because, while travel is significantly influencing the headwinds from a risk appetite perspective, there were many years where, we all, flew on the backs of the airlines and the cruise lines, particularly since 2015, and that growth. And we've all built industries around that. So we've all benefited. I think that the real challenge that's going to be right now is once we start getting past this and you think about the human factor, as we start opening up, and when people talk about opening up industries, opening up regions, the immediate impact is going to be on restaurants and vacation. So it's going to be allow people to travel, and those hotels and those restaurants and the bike rentals and the car rentals that are associated with that. But there's, as we start to open this, we still have employees that will be called back to work that their children are not in school or there are not daycare. And so unfortunately, I think the recovery will also hinge on the ability for us as humans to be able to organize our lives so that we can actually get back to work. And you're going to have supply chain issues. You have entire factories that have been shut down for 1 month, 2 months, in the end, maybe even 3 months. And there could be thousands of orders backlogged. So that's why it's so important around the PPEs and all the loans that the government is giving. And they're not to help merchants invest or grow or transform. They're really trying to focus on those industries and those businesses that are going to be the most impacted in bridging the ability for them to be there 60 days or 90 days from now. So I think to answer your question is, it's not one single industry that is either impacted or will recover first out of this. It really is the entire, the way that we live and the way that we interact and the way that we deal with our families and our daycares and our neighbors that are going to drive what industries come back first.
Hey, Mike, if you have some more time, there's some additional great questions that have just come in.
Yeah, sure. As long as they're not too hard.
These are good ones. This one is a great one. With Hertz filing for bankruptcy, how would smaller car rental be underwritten?
Yeah. So I don't think that anybody's going to focus on an individual segment or industry and then cherry pick inside there. I just think the standards are going to be very difficult to be able to meet in the near term. So as long as you're financially sound, you have the cash to be able to manage your NDX or your non-delivery risk, or have access to capital, be able to do that, I think you're going to be okay. And more importantly, you're not going to have, as you're a small regional or maybe even a local car rental, you're not going to have the billions and billions of dollars of risk, and you have that capital and you have that inventory that allows you to scale. But in a downturn, that's a very, very expensive OpEx that you're going to have to maintain. The smaller companies are going to be able to weather the storm, I think, better because their OpEx is going to be much smaller. And so I actually feel that the local and the regionalized car rental companies are going to do better.
Thanks, Mike. All right, one more up on the board. With liquor and cigar stores trying to adapt to online ordering, previously these industries were categorized as high risk. Is there another viewpoint underwriting to board these industries?
Yeah, so I'm gonna think out loud here for a second. I think the industry was really worried about cross state line ordering. If you think about the wine industry, so first you have jurisdictional differences around age, and then you also have the lobbyists in those states that do not want big companies shipping wine in. They would think about the automobile dealers. You know, a dealer is an independently owned franchised. You don't want General Motors or Ford or Tesla to come in and actually start selling direct, which will actually be circumventing the business model that you've built. So you have, that was a risk for being able to open up the payments ecosystem to those industries. However, I do think that in times of crisis, viewpoints change and regulations change. And I think it's going to be baby steps. So if you think about the liquor stores and the wine stores, the ability for them to even now go to a curbside delivery and take the order in advance, and nothing's different than taking the order through card not present and shipping it 4,000 miles away. It's really irregardless if it's 10 feet or 4,000 miles. But I think the regulators would say, we're much more comfortable with it being a curbside delivery or a local delivery. So I think they're going to experiment with this. They're going to open it up, allow you to do online sales of this. And then if that goes well, and you don't get a flood of consumer complaints or a bunch of regulatory issues, you'll start to see that opened up and expanded as we come out of the crisis.
All right, Mike. Well, I think we're good on the questions, and thanks for the extra time, and thanks for helping us and educate industry professionals. It is it's just a way to not just bring value to your merchant, but really what are we in this for, right? It's if you've got to be in it for your client and for the merchant, and we're hoping that today we were able to deliver some valuable information that you could take to the client, to the end user, and not just educate them, but in some cases, help them not just grow, but in some cases maintain their business. So, Mike, thanks again. Appreciate it. Folks, we'll be gathering this and posting this on LinkedIn and a few other social media venues here in the next day or so. Feel free to share it. And we look forward to continuing to deliver this type of content and valuable information on a regular basis. So thanks, Mike. Thanks to all. And that'll do it for today. Have a great rest of the week and a great 2020.